Hello, everyone, and welcome back to another episode of Test, Optimize, and Scale. Joined here today by Gregory Burke, who I had the opportunity to meet at the Crowdfund Professional Association Summit last year. Actually participated in meetings with the SEC, various different groups on the Hill around tax credits, around various initiatives that we're a part of. Greg Burke, PhD, CPA, Assistant Professor, Accounting and Business Law for the Loyola University, Chicago. Want to add one of the brilliant minds in this space, someone who goes to the extra levels of depth in terms of researching how issuers are benefiting from regulated investment crowdfunding, the impact it has on investors and the finance community. I am always learning from my conversations with Greg. We're going to be talking about his recent research, his study, very meaningful findings here that we're going to go at length around today. Greg, thanks for taking the time to come on here and join an episode of the podcast.
Awesome. Happy to be here. Thanks for the intro, Jason. Always happy to share my stuff, the little incremental knowledge that we can share with the industry and other academic folks alike.
Absolutely. It's a new space. I've shared with you before my perspective that there's many misconceptions out there. So the more clarity for the academics, for the issuers, for the investors, for the portals, for all the service providers, the better the ecosystem is for everyone.
Absolutely. I agree. I think that's one of the really important things about exempt transactions in general, and especially those that are crowdfunding, right? There's very little information, very little data. And so relative to what we think about larger firms, and I think any kind of systematic research or systematic data analysis or information is going to be beneficial to everyone to continue to legitimize this growing industry.
Absolutely. We can't only look at the wins, can't just hear the war stories of the losses, as much as the aggregate data, what it shows us, and creating more of those best practices, more of that roadmap to succeed. But curious and want to familiarize the audience a bit with your background, your storyline. What got you involved? What got you involved in this world of regulated investment crowdfunding? What put it on your radar? How did you get involved in the space?
Sure. Well, my backstory is I was originally a CPA, and at that time, I of course, well, most of us CPAs aren't working on small firms that are issuing securities like this, and so I wasn't particularly familiar. But then, during my PhD program at Duke, during that time, I dug a little bit more into the Jobs Act and some of the changes that came out of that for exempt transactions that kind of opened the door for these small firms to raise capital, and also for non-accredited or non-wealthy investors to
Right.
have some of the action, be part of the game. And so that just kind of sparked my interest. So spent some time over in Duke Law, learning the ins and outs of that, getting a co-author over there, really understanding the legal part of the space, and then eventually moving towards the data and understanding the economics of what's going on there. So, I've been doing that for the last few years, since grad school, and now continuing that during my time here at Loyola as an assistant professor here.
And I believe this is going to be the primary approach towards capital formation, just a matter of when, right? And you were intrigued as a CPA. You had mentioned a lot of CPAs, they wouldn't put time, they wouldn't put energy into working with these smaller firms. But as you looked more into Reg CF, as you looked more into founders, CEOs connecting with investors, both retail and accredited, not just the high net worth, high household income audiences, you saw the potential. What, where do you think this whole space is going? There was about 1,400 Reg CF issuers in 2024. How come that number is not 5,000, 10,000, 100,000 of the, 24 million some odd small businesses in the US? You were driven to this vertical. So was I. I look at fundraising as a major aspect of whether early stage, mid stage companies succeed, whether they grow, whether they are on a path to their way out. Uh, what has pulled you to this space in noticing that there are more companies that could be utilizing these exemptions, and this is the path forward?
Goodness, there's a lot to respond to there. What I would say to clarify my response to this, none of my research per se directly answers those questions, but based on my knowledge of the industry and the securities law around it, I can definitely give my opinions. Uh, what I would say is, for sure, for years we have seen that uh, capital formation, raising firms raising money from the capital markets has been dominated by exempt transactions, far outweighing IPOs or S1 filers that are going through the traditional registered offering. And so this has been going on for years. And, a lot of that capital is going through Regulation D, which isn't the stuff that we necessarily in the regulated investment crowdfunding space. We don't really see that often.
Sure.
There's a little bit of that, but a lot of that's happening kind of behind the scenes and has been the capital formation that was going on before the Jobs Act, right? And now uh, we can finally see that open to a broader audience, right? And see the light of day. So now that capital formation under investment crowdfunding can occur with all eyes available. And I think what's the tension right now that I see based on my just kind of opinion and gathering anecdotes would be that there's this trade off between the traditional capital formation for early stage firms and this, call it new age investment crowdfunding, where the old guard, I think there's some concern of crowdfunding being associated with weaker firms, right? I couldn't get a VC, I couldn't get somebody else to just propel me forward. And so, crowdfunding was my last resort. I think this is an old opinion that is changing over time
Yeah.
as the area legitimizes, and I think that's why we see that it's growing, especially in the post-COVID era. So now, what is exciting about it is that firms that want to grow that never had access to the Rolodex of venture capitalists now can put themselves forward for the world to decide about them, right? And you and I and whoever our neighbor down the street can invest in them if we see them as worthy of investment. And that's the cool thing. That's the new thing, right? That the mom and pops or you know mom and pops of the world that wanted to invest, but in startups that just couldn't, now they can. And so, yeah, so I guess in summary, it's, it's finally I think we're at a point, a nexus where the industry is maturing and people can put offerings out in a crowdfunding space with less fear of the venture capitalists looking at it and saying, hey, this makes you look weak. In fact, maybe it's actually used to market towards venture capitalists, but that's you to know more than it is to me. And yeah, I think that has legitimized the space and opened up doors for firms that never would have otherwise had access to capital.
Completely agree. I recall the early days of Reg CF, 2016, 2017, and heard VCs, heard different groups that were considering to go down this route, or service providers and advising issuers not to go down this path and stating, hey, if you can't get funded offline, maybe you look towards Reg CF. And
Hmm.
have worked with many groups over the past few years, especially after that 2020 rise of the retail investor, the Robin Hood investor, if you will, as it's stated in many articles. There was just so much more activity. We are seeing month over month growth of the space for Reg CF, as well as what was happening in Regulation A+. We were actually brought in through Reg D 506C. Those were the first campaigns. We've worked on a decent amount of side-by-sides these days, and also, still some standalone Reg D clients. I find less data, less information on it, and I know many
Sure.
of the Ds are 506B, and we can't solicit, we can't really market anyway. We can help
Right.
polish up their content, but it's existing investor bases that you're really looking to bring in. The issuers I speak with now that I work with, particularly the ones who have gone from Reg CF to Regulation A plus, they're doing what you were touching on there, where they'll have a successful round. They'll be speaking to different strategic investors, perhaps some different venture capitalists, some different investment banks thereafter, and they'll hold to their terms and say, hey, if you're not happy with this valuation, and we could just go back to the crowd. They have an actual power in those discussions. They don't have a limitation for which investors they can reach out to and as part of their next round. Uh, it creates that even playing field where any issuer that we speak to tomorrow, we can market to audiences that we've seen invest in these types of deals in the past. The investors, of course, have access to this deal flow. I just think it's such a great thing across the board. But to your study, to your findings, uh, in fact, instead of me just looking to summarize or mention your hypothesis, but what do you want the audience to know about your study? As we get into some of the details, which I've seen firsthand and have seen benefits, I've seen obstacles that it creates for issuers around reporting and a few of the topics you get deep into. What inspired you to put this study together? What are some of the overarching themes? And where would you like to start in terms of what became abundantly clear to you through your research?
Yeah. So, really high level, and you're touching on this throughout our conversation, is a lot of this comes down to disclosure.
Mm.
What's the information that firms are providing anyone, investors, regulators, etc., to make decisions? And this study is particularly focused on their ongoing financial reporting obligation. So, within as a step back to provide a little context here, most crowdfunding work in terms of academia or research, a lot of it's focused on what kind of stuff leads to a successful offering,
Mm.
right? So the initial crowdfunding placement. And when we are talking about disclosure related stuff, it's all in terms of that outcome. Did they raise a bunch of money? Did they meet their goals? Did they have a lot of investors interested? That sort of stuff during that time. What we're doing, which is new to this space, is thinking about hey, you have raised some money and now you have this obligation to file an annual report every year. It's just like a public firm that goes public, they do an IPO, and suddenly every year they have to file a Form 10K, or every quarter they have to file a Form 10Q.
Right.
But for these issuers, their requirement's much less. That's part of the exemption. They only have to do it annually. It's a much smaller report. It's called Form CAR. And so our study is completely focused on the decision to file a Form CAR. The big takeaways that we want people to learn from this is number one, compliance in this market is very low. When we think about the corollary for large firms, the Form 10K, the annual report there, functionally everyone's doing that because the SEC is monitoring it, people are paying attention. And so when they need to file their annual report, they're doing it. In this market, though, compliance is imperfect. And in fact, uh, over half of issuers never file an annual report, and about a third file it timely on the year after their first raise. So compliance is really low. So first, we want to kind of establish, hey, this is going on. There are crowdfunding issuers that are not meeting their compliance annual reporting requirement. and document some facts about them. What does it look like? When do they file? What type of people file, et cetera? And so we have some stuff about that we could dig into. And then from there, we want to understand what leads to compliance, right? Why would a manager comply with this? And for this, not only do we learn within the investment crowdfunding space what would motivate a manager to comply with their annual reporting mandate, but I think we kind of want to think of this as a laboratory to think about annual reporting compliance, financial reporting compliance more broadly. Because unfortunately, we can't study this in the larger market because, as I said before, everyone's doing it. And so, since there's no variation in people doing it, we can't really figure out what would get someone to do it versus not do it. And there's also a ton of enforcement. And so, even if there were other reasons to report, the just really overbearing enforcement might overpower any of those other reasons. And so, what's cool here is we can look at different reasons. And so, what we do is we first establish some correlates just using the data. What kind of things are related to that? And so, uh, what things might be correlated with the decision to file their annual report and doing it on time? And what we find is underwhelming. So we have some stuff, and I don't want to spend too much time talking about that right now. We can jump into it if it's helpful, but basically what happens is we have a ton of really rich data from King's Crowd, as well as stuff that we've collected from public spaces on Edgar.
Mhm.
And even with all of this data at our disposal, we can't find really reliable correlates with the decision to file. And so what's cool about this paper is we can then turn to this randomized field intervention. And so the backstory for that is that King's Crowd in 2024, around the annual reporting deadline time, wanted to understand, just like us, what are things that drive annual reporting compliance. They also have a subsidiary called Raise Papers. So they were really motivated to drive business towards Raise Papers and also understand this general phenomenon in general. So anyway, so we partnered with King's Crowd. And they initiated this randomization, and we get to benefit from what came out of it. And the main things we go into this thinking about are kind of four potential motivators for annual reporting compliance. And maybe I should have said this earlier in my rant here, but thinking about the regulatory risk that these founders face, does the regulatory risk impact my decision to file, yes or no? The potential economic benefit of doing so. Does filing more, and this is a good one to jump into as well, does filing my annual report impact future raises? Do investors care, et cetera? The monitoring of these firms. So the monitoring could be from King's Crowd themselves. It could be from if they have an auditor. It could be if the platform that they're raising on is got good due diligence, et cetera. And the last one is compliance costs. You and I both know that when things cost more, we're less likely to do them. And
Yeah.
so, and the resources, right? If we have more resources, we might be more willing to do things that cost more, et cetera. So these are kind of the four things we think about in general in this study. When we get to the actual experiment, the actual field study that King's Crowd initiates for us, we kind of have to boil it down to just a couple of things. And so King's Crowd sends out these randomized emails, some of which are emphasizing the potential economic benefit to these issuers, and some of them that's emphasizing the overall regulatory risk. So uh, it allows us to compare these two things to one another. And those are kind of our primary two comparison, this versus that. And the takeaway from that study is that the emphasis on regulatory risk is what matters. So we can see a take up in the in the filing of those issuers that are treated with an emphasis of regulatory risk relative to those that don't receive that emphasis. And so that's kind of the main takeaway there. It's all of these things are small, right? So I think our baseline compliance rate for 2024 was about almost 17% uh, to comply with the annual reporting mandate. And then we demonstrate about a 20% off of that baseline increase based on the regulatory risk emphasis. And so that's kind of what we can say. And given that, we can talk about takeaways. Maybe I should hold that for you, but I think there's some very clear takeaways from it that sent just high level. We're sending just an email and we're seeing an increase in compliance. So those are kind of the main things. There's a few other little things here and there, little nuggets on things that we learned, but the big ones are it's hard to predict annual reporting compliance with data.
Mhm.
With a randomized field study, we can see that regulatory risk and founders understanding that increases reporting compliance. And so that's an important thing for us to increase the compliance within this market and in markets in general.
It's just wild to me to think that less than half of issuers are in compliance with the annual reporting rules. And I think it was something like 28% do it on time, 53% never at all. I understand why it's weekly predictable. And I just see so much opportunity in reporting as a marketer. I mean, first of all, I watched the space around that April 30th deadline, and campaigns will close to avoid the additional Form C-AR. And I think it's a bit over 500 Reg CFs that were live 2025 April, and a couple hundred of them closed. Now, given closing can spike a volume of investments, uh, prospects who are on the sidelines and they hear that end date can have a fear of missing out and hop on board. So I would tell you some of the issuers that actual closing is part of strategy. I would also tell you from my seat at the table that we work with groups post fundraising, in some cases around their growth marketing, in many cases around continuing to communicate with their investors. We've worked with groups, some of those Regulation A plus issuers have over 50,000 investors at this point. Even if it's, a few thousand, be it a few hundred, there is, again, a real opportunity in continuing to stay in touch with them. Rules, laws aside, just, hey, you invested in us. This is what we're doing now. Here's how we've grown. It checks boxes for the investor. They want to know where their money's gone. It can help the issuer avoid issues down the line of investors reaching out to them. Hey, I want to know what's going on over there. Well, we'll see investors putting negative comments online, negative comments on advertisements. I haven't heard anything about you guys. Is this a scam? What's happening? So you're alleviating the investors' concerns. You're giving them new things for them to be excited about. You get to craft the entire narrative. So again, even outside of the regulation, there's a lot of benefit to keeping the conversation going, if you will, with those audiences, particularly if
Absolutely.
you're going to do another round. And, I will see a good percentage of investors from round one participate in round two and round three. And then later we've worked with groups on their seventh, eighth round. So there's far more lifetime value in each one of those individuals. And again, that's outside of everything around the regulatory risk. I would say there's an economic benefit there. It's uh, it's definitely eye-opening to see that there needs to be a threat. There needs to be a regulatory risk to really get some of these CEOs in action. Like you said, there's costs.
Yeah.
There's a lot of different aspects and time being one of them that are involved in getting everything filed and taken care of and getting the update out there. But it just seems like such a great thing for, we'll use the term again, all sides of the table to have these updates occurring. So it's
Yeah.
mind-boggling to me that so many founders miss it.
Totally. I mean, there's a lot to unpack in what you just said. I think starting from the top, one thing you mentioned was raises closing early, right? Right before the reporting deadline.
Yeah.
And I think even for your listeners, this is an interesting phenomena that happens, and is a great promotion for another working paper with my co-author, Riley League. So myself and Riley is my co-author on this paper, and we also have another paper that is not publicly available yet, but is being should be out hopefully this coming winter spring, where we look at the closing behavior of ongoing raises, which is a little different, right? So we look and we see this phenomena of, well, we knew it happened, right? And so then we documented empirically that people are closing in April before the deadline or in March before that April deadline to avoid what they to avoid doing their annual reports.
Yeah.
And so, what's interesting about all of this for your listenership is if you've successfully issued securities, closing early doesn't actually allow you to avoid that obligation. So I think uh, this spike in closures is actually a misunderstanding of this market. I think a lot of folks think that if they close, they don't need to file an annual report that year. They get to skip a year. They wait for another year to do it. Uh, but what's interesting is that's not the case. And what we can do in our paper is we can observe when raises should quote unquote close. We can estimate when their optimal closure date would be.
Mm.
And then we can see when they close because of this misunderstanding. And we can estimate how much money they're losing because of financial reporting, which allows us to put a dollar figure on the cost, like a literal dollar figure on the cost of annual reporting for these small firms. And that's using an analytical model that then we estimate using the data, and that one's coming down the pike. So keep your eyes open for that. It's a really cool setting where this, as you know, like everyone knows in the industry that this is happening, and we can kind of use that to our advantage to estimate an actual dollar value for annual reporting. So that's one part of your long response. The other thing is, oh yeah, go ahead.
No, laughing at the long response part.
Yeah, yeah.
I
Well,
try
it's
to
just
keep
there's
it brief,
so much good
passionate
stuff
about
to
the
talk
topic.
about.
Yes.
Yeah, I think.
Keep going.
Yeah, yeah. So I think that's one thing to think about, right? So
Yeah.
we're able to kind of estimate that cost based on that behavior that's observed in this market, which we find to be pretty interesting. And the other part that I wanted to kind of point out related to this paper is that we show that investors do care about reporting. You and I can kind of say investors care, but we got to see it in the data to know that for sure.
Mhm.
And what we show, we use Edgar logs. So the SEC reports data on visits to Edgar, and we can track that data to a specific company, and in fact, a specific document. And so that publicly available data, which is very big, I wouldn't recommend the average user to try to download it and work with it. They're huge files. We use those files to look at, are investors looking at annual reports? And the short answer is yes. And the more extended answer is yes, especially at when they are due,
Mm.
right? So there's a high uptick of investors looking at annual reports around that April, May timeframe when they're getting posted. So we can see that in the data, which makes sense, right? You would want to look at an annual report when it's fresh, right? If you look at it a long time later, it's not as useful anymore, right? Because
Right.
it's time stamped, essentially. And the other thing that we see, which is interesting for the ongoing raise, and particularly for marketers out there that are trying to help these companies raise money currently, we see that when an offering launches, like a secondary offering. So if you've issued securities before and you should be filing a form CAR, and then you start another crowdfunding offering, we can see in your first couple of weeks of that new offering, people are looking at your old CARs. Like it's just a fact. We see it. And so, you know, this is a thing we can't say whether or not the investor goes to look for it and they're sad when they don't see it or they're happy when they do see it, but
Can't
they
measure that.
clearly care about it, right? We can show that they're looking for it. And so, that's empirical evidence that, an issuer should consider, right? That their investors or potential investors are looking, and that is spiking right after they start a new offering. So you you can imagine, again, this part's purely speculation. If I go looking for an annual report of an existing offering and I don't find one,
Red
or
flag.
I go looking for it and it just does not look well done, right? It's not following the accounting rules that exist. The disclosure itself is like not robust or reasonable, or it looks like you threw it together on a napkin and scanned it and uploaded it to Edgar right before it was due, right? All of those things, if people are looking, they're going to notice. And I think that those things can impact, to your point, subsequent raises.
Oh yeah.
Right. And whether or not it should is up for the market to decide.
Of course.
Uh, but it's certainly a thing they're looking at, and it's undoubtedly, when it's not posted, a violation of securities law.
But it's also surprising to me that this is somewhat a low enforcement setting.
Yeah.
If they want to make an example of you, they can, and it could be horrific. But it's again, I'm from the school of you do the right thing. You're
Yeah.
missing deadlines. It's going to come back to you. You're going to get something in the mail. You're going to have worse occurring. So do you believe, and this could be speculative, of course, that more enforcement is coming? More of these issuers who have not filed their CAR historically are going to run into trouble, or other areas of the exemptions are going to have more of a magnifying lens on them? Or do you think it'll remain this way for some time?
I have a few thoughts here. But again, these are not based in data. These are
Right.
based in my understanding of the law and from some conversations with regulators. Uh, I would say that, uh, and also the context of right now, we're in a government shutdown, right? So
Yes.
in this exact moment, there's a skeleton crew at the SEC kind of keeping things afloat. And the point isn't to say that the government shutdown is going to impact things, but it's to drive home the point that the regulator, the SEC, is resource constrained all the time, right? Right now, in particular, with the shutdown, but they're a resource constrained entity. And so with that resource constraint, and whatever the agenda is of the commissioners, especially the chairman, is going to impact where time and efforts are spent. And so one could make an argument, and I'm one could make an argument that these smaller issuers, these crowdfunding issuers, are not a priority, right? When I only have so much time, where should I spend it? Should I be making sure that they're doing their annual reporting, or should I be chasing, you know, or following whistleblower tips, or chasing potential fraud in the market, or other kind of financial misrepresentation or errors, or whatever else is out there for the enforcement folks to be focused on? And so my what I suspect is that I don't foresee there being a huge change in the enforcement behavior around the annual reporting. Uh, I think there just hasn't been the resources to do that to this point. I don't want to say whether or not that's a good thing or a bad thing. What I can say is if there were more, based on our study, there probably would be more reporting, or if there was more reminders or more salience of that regulatory risk. So I'd say that. The other thing I'd say in this space, uh, relatedly, is that the crafting of regulation crowdfunding specifically, uh, they were very careful to write it such that there was kind of, let's call it a carve out, a safe harbor of sorts, where if you don't do this annual reporting, you're only violating regulation crowdfunding, which avoids a, without getting into the technicalities here, which avoids a bigger issue of you violating larger securities law issues.
Okay.
So they were clever at the time because they knew these would be smaller, less sophisticated issuers, and it would be more likely they might miss this requirement.
Hmm.
Uh, the exception to that, which issuers should know, is that if you're really big, again, this is non-technical, trying to make it non-technical. If you're a really big issuer, uh, those safe harbors can go away. And so in such a case, even if you've only raised money on regulation using regulation crowdfunding, that exemption, if you're a big issuer, you may not be in the safe harbor anymore, which is a bright line, can be a bright line for the regulator. And if there's going to be any enforcement action, my guess is it's going to be going after those larger issuers. And frankly, I think it's logical, right? Those larger issuers are going to have more investors. There's more capital on the line. The regulator needs to protect the larger groups of investors, et cetera. So uh, if there was going to be anything, it would be with those guys, both because the legal oomph is there, and also, there's just more to chase after potentially.
And I mention regularly in my content, do everything compliantly. The nature of my question is not to say, hey, can founders get away with this, as much as
Totally.
should we be expecting more? Is this going to be a news headline? More along those lines. But I don't submit advertising, creative messaging to a client without saying, hey, you need to get legal sign off. I don't say anything about topics outside of marketing in terms of structuring these deals without words along the lines of, hey, you need to make sure everything's compliant, make sure you're running this by legal. I applaud that about this industry, this space. It creates that safe environment. Uh, I don't hear stories of fraud. I don't hear too much of what I hear in the reward crowdfunding space going on. I do want all these rules to be adhered to. I'm going to be pointing to this in my conversations with clients, even prospective clients around the reporting. I'll be looking forward to the report that you're putting together around groups closing early. I actually think it is to some degree stumping growth in the space because there's only so many Reg CFs live at a time.
Yeah,
We spend half the year catching back up to numbers that we were at April of that year. We're still not back up to anywhere near 500, about 420, call it, Reg CFs live right now. So more in April, and then it dips down to high 200s, 300s from our research. So
totally.
I want to see groups understanding, hey, they need to file anyway, continuing to build because it's a lot easier to get an investor to convert if you have hundreds of thousands of dollars raised versus starting back again at zero, or we'll call it sub 100,000. A lot easier if you're at 1.5, 2.5 to hit the full five versus starting another round at a later point and trying to hit 1 million, 2 million again. So I want to see a higher success rate industry wide. I want to see more adoption, more mainstream adoption, more awareness. I'm still explaining to people after 9 years what regulated investment crowdfunding is on a daily basis. So I think more noteworthy campaigns will help get us there. And I certainly don't want to see a news cycle talking about all of the issuers who are not being compliant, not following the rules, and are now being adhered to.
Totally. Yeah, I think, I want to be clear that, myself and Riley as the co-authors don't try to make a stance in terms of good or bad, I guess, in terms of the choice to comply or not comply. I think we're just trying to measure it as we understand the rules and we, try to we try to match the rules up with the actual behaviors we can see in the data and learn from that. So, I don't think, to your point, I don't have I have an opinion, no evidence in terms of, what these issuers look like and if they're trying to pull the wool over anybody, but it's certainly not what I'm expecting is happening out there. I think, there are active reasons to choose to comply and not comply. And, some of that is awareness and some of it might be to what we're testing is, regulatory risk, economic benefit trade-offs, monitoring that's going on, and related compliance cost. But certainly not I don't think a reader should ever take away from this paper that there are bad actors out there, per se. So that's certainly not a point we want to make in this paper. But yeah, I agree with your other observation in terms of the closing the offerings early. I think I mean, that's kind of the point of the paper that we're writing, that the issuers are giving up dollars that they could be raising by
Hmm.
closing because of this
Hmm.
reporting deadline. And so, uh, there's a lot to unpack there. But it definitely tells us that financial reporting is burdensome. It just says, like, if it wasn't burdensome, they would do it and they would keep running their race, right? And so that wouldn't be an issue. And so the as an accounting professor, I hate to think that doing some accounting and putting together a financial report is difficult. My students certainly may not agree with that, but I think this is a question that issuers should consider, right? I suspect that some of the issuers out there just know there's this extra reporting requirement, and the idea of accounting sounds scary and a lot. And so the actual cost of that isn't completely understood. Uh, it's estimated, right?
Mm.
Kind of in their brain in some way. And that's kind of what we're capturing in the paper. But, I think spending a little time, and when people will see our paper, they'll be able to say, hey, quantitatively it looks like on average issuers are giving up this much money for financial reporting. Is that actually worth it? Like, would I be can I get these things prepared for less than this? Because if so, I should just get it prepared and keep going, right? I think that's a potential way to think about that paper that's coming down the line.
It's a good outlook. It's something I'm going to be pointing to in my conversations. That'll be very interesting to look at the perceived value, the perceived loss. Again, I try to have those discussions, and I'm speaking with many issuers March, April about what they're going to do. So I'll be bringing that up in my dialogue. In your research, in your studies, in your perspective on this exemptions market, what recommendations would you have for a founder, a CEO, a marketing director who's tuned in that could allow them to have a more successful, more meaningful raise? This could be around a marketing test, around the structuring of their campaign, around this actual study and filing Form C, AR, doing updates outside of that to communicate with your audience. What should they test out towards their growth? What would you recommend?
Yeah, so this paper doesn't per se test does X action increase funding for an offering. From this paper, we can see that there are investors that are looking at annual reporting, we can see that those that do annual reporting on average are raising more money in their subsequent offerings. And so those are kind of correlated with the idea that annual reporting matters to have a successful offering. Uh, but this paper certainly doesn't test that. There are just from my knowledge of the literature and some other stuff that I've done, there's a lot of things that impact uh, outcomes during the actual offering process. But I hesitate to list them at this point as the be all and end all. But I would say the academic literature has tested a bunch of different things. For example, does having a patent, matter? Does publicizing that matter? Does, the experience of the founder team matter? These are all things that different papers have looked at. I have another paper that looks at the role of the King's Crowd analyst report and how does that impact funding. And the answer for that paper is yeah, it does. So uh,
Well put.
higher King's Crowd analyst report outcomes, or you could think of in terms of a recommendation, although they're clear that they're not providing investment advice, but a higher report outcome is leading to higher funding. So get a good King's Crowd analyst report. I can say that with some confidence. But more broadly speaking, in terms of your question, I would say to a founder when thinking about my paper that we're talking about today, you should understand what you're getting into when
Yeah.
you decide to do a regulated investment crowdfunding raise. And even more specifically, the way I would phrase that is you should understand what you're getting into when you choose regulation crowdfunding, when you choose regulation A plus, when you choose regulation D. Like, what is that regulation? What are the trade offs you're making? And what are the requirements that are expected from it? Right. So each of them are going to have different trade offs, right? You can raise more with some, but because of that, you have to disclose more, right? Or you have more monitoring from the SEC. You can disclose less, but you have to raise less, right? Or there's more investor protections, right? There's these menus of trade offs that are associated with each of these options. And I think founders should have a better understanding of them. One of those things is the ongoing financial reporting, which this paper is all about. And so I think, before going to market, being like, hey, like, am I ready to bear the cost of filing an annual report every year? Like, can I do that? Like, because I'm supposed to. So, understanding what that is and having a plan in place around it, uh, assuming that you want to comply with the regulation, right? Which I think most people do, right? And so, just being aware of that stuff up front, I think is kind of what I would say to founders, being like, hey, like, when you decide to do regulation crowdfunding, here's the stuff you have to do. Like, if we're going to follow the letter of the law, here's what we're supposed to do. There are some occasions in which you can stop the annual reporting, which I'm not going to get into here, but understanding what those things are and what circumstances I'd be in that boat and what I would have to do that, et cetera. So I think having full transparency and awareness before going into the offering, I think will impact the success of that offering probably, and also subsequent offerings, especially if you remain compliant with that. Because as I mentioned, investors are looking, they are noticing and seeing the posting of Form CAR. So that certainly we could extrapolate will probably impact subsequent races.
Mhm. And that means we could appraise marketing value around what that traffic looks like, the people looking at Form C-AR, CAR, especially from investors who are participating in the space and projecting the amount of conversions, the amount of transactional value at that. What about issuers who are listening in and they're saying, we were told this, we were prepared, it's been spelled out to us clearly. Meanwhile, we're not seeing as much traction in our second round. or our current round. Have you been able to find any clues? They say success leaves clues on how to optimize, how a group can look at, let's call it marginal performance, marginal success on a first round, on a second round, and perform better on a later round. Anything that you've seen in the data that would be a good blueprint, good roadmap for founders to hear.
I think, this is the silver bullet question, right? Uh, I would say to be totally transparent, I don't have a great answer to that. I
Okay.
think, I think the only thing I can say with some certainty in terms of this paper, because I don't want to extrapolate too much on that, because money's at risk, and I
Yep.
don't want people to do the wrong thing. What I can tell you is that investors look at annual reports, old annual reports when you start new raises, as well as the most recent ones. And so, uh, if investors are looking, I would suspect that they are making decisions based on looking at that. And so,
Hmm.
in terms of this study, I would say that may impact offering success. Beyond that, and how relatively important that is to, if you've got a good pitch video, or if you're working your existing customers to get involved in the offering, I can't speak to how those compare to that and other things. So,
Fair enough. And
yep.
I do think there's a recommendation in there where filing the Form CAR, is a step towards getting better performance on the next round. It is a step towards optimizing, especially if you haven't done it and you're in the planning process for that next capital raise. So I think there's a lot to build off there. For me, it's going back to testing new audiences, new messaging, new funnels to take the audience down. The success on one of these Reg CF campaigns is really based on enough traffic at a high enough conversion rate. A
Yeah.
lot to unpack for each of those, but there has to be enough traffic going through, has to be a high enough conversion rate. Uh, could write a book on each of those, but those two components.
Yeah, and this is, related, the annual reporting, one can think of, I think, in two ways, in terms of the ongoing offering. One is investors, I think, like to see that the people they're investing in follow the rules. This is just conjecture, right?
Dude,
But I would think that, if I were investing in one of these offerings, I would want to know that the founder, like, is smart enough to know the rules and cares enough to follow them. And so, just complying itself, regardless of what's in that report, indicates to the potential investors, like, this person, number one, knows what's going on. Like, they're smart enough to know the rules, and they also care enough to follow them. And so I think that itself is a signal to investors. And even if that doesn't matter to an issuer, if an issuer says, "Hey, like, I'm smart enough and I'm choosing not to do this because I don't think investors care whether or not I comply with rules." One might say that. I'm not saying that that's right or wrong, but the other thing is investors care about having information when making decisions. Some more than others, and having an annual report or a history of those annual reports provides that information. So another way to think about it is just, do you have a good Q&A section? Right? This is kind of like that, right? It's like, do I have good keeping track of how things have been over the last few years? So if an investor wants to know it, they have that information at their disposal. So, it's kind of two stories here, right? It's the information story, it's the just pure compliance story as well. And these aren't sussed out per se in this paper, but certainly something that we've thought about in the process of writing it.
being able to manage a campaign to a point of effectiveness, like you said, the silver bullet. Love the tips that you're giving here to really set it up for success as a whole. Have another, golden question for you of how do groups scale? How do they hit the full $5 million limit? How do they hit, multiple eight-figure levels on a Regulation A plus campaign? Uh, how are those groups dealing with their annual reporting? And is it set up in a Apple, Steve Jobs, Tim Cook fashion where it's a full presentation? Is it around the announcement of the next campaign that they're really rallying everybody together, but pointing at the AR? What can you say about the largest issuers in the space? Any tips, any examples that founders could test out for themselves from there, whether, again, it's around marketing, filing, or really around your findings from this study and around annual reporting?
Yeah. So again, I hesitate to give a great answer to this one. What I would say as just a caveat is that our study is uh, purely focused on regulation crowdfunding issuers. So although I'm aware and have a good understanding of A plus issuers and Reg D issuers, uh, our study is only speaking to the reg crowdfunding issues, and part of that has to do with the fact that the uh, compliance obligation between those issuers is different, and the firms that are raising from A plus on average are different from the ones that are raising on reg crowdfunding. Not any given one to one, but on
Right.
average. And so uh take that for what it's worth when interpreting these results. I would just want to make that clear. But again, I think, you know uh in terms of our study, uh I'll just go back to, like, investors are looking at annual reports, right? And there's enough variation in those that are doing it, that those are that are don't, that you have the opportunity to stand out, right? If you already know that half the other issuers out there aren't ever doing this, well, that might be a way for you to stand out relative to that other half.
Yep.
But, in terms of how many dollars does that change for you? Hard for me to say. Hard for me
Sure.
to say. Yeah.
But like you said, you want to invest with the founder, with the team that is doing everything compliantly. They follow the rules. They're priming the company for ongoing growth. I'll throw the word compliantly in there again, especially using the word priming. So you want to be one of the minority, not the majority, that actually file on time. You're getting that traffic, you're getting the investors who are searching around. I think there's a lot of great things to highlight, a lot of great takeaways for the audience that's tuned in here today. Have to ask the large question of where can everyone go to find this study? Where can they go to learn more? And any final thoughts you want to leave us with today as we begin to wrap up?
Yeah. So I guess two parts to that question.
Yes.
The first, in order to find out more information, the paper is currently posted on a repository that us social scientists use called SSRN. So if you're familiar with that, you're welcome to search for it there. If you're not, which I assume most folks don't, consume academic research every day, I would say check out my website. I have a website that has it posted and a link through that. My website is gregory-burke.com. And if you click on my research page, you'll see the abstract from the paper, as well as a AI generated podcast, kind of meet that talks about the paper, and a link to the paper directly. So I would say if you want to find out more, check it out there. The actual name of the paper, just for your own searching reasons, is called Equity Crowdfunding, in quotes, Rules: Compliance with Mandated Ongoing Financial Reporting in an Unenforced Environment. And it's co-authored with my friend and colleague, Riley League, who is at the business school in University of Illinois. So that's where you can find out some more information. And my website in general, I try to update with other projects. So if there's other things related to crowdfunding that you're interested in, you can kind of check that stuff out there, and there'll be links to other things. So that's the learning more information, especially related to the stuff that I'm doing. In terms of kind of final thoughts, what I would say is that our study provides us some insights into why managers comply with financial reporting obligations. And it tells us that Regulatory risk, as we suspected it might matter, matters a lot. When there's other opportunities for things to matter, like economic benefit or monitoring or compliance cost, the thing that still dominates when those other things could matter, when they could matter, the thing that dominates still is regulatory risk. And so, uh, what and the other thing is just observationally in the regulation crowdfunding space, compliance is super low. And we have a bunch of fun facts about when people are doing it and how they're doing it and other things like that. But compliance is really low, but we can increase compliance with a simple email reminder emphasizing regulatory risk. And so when it comes to that, if we care about annual reporting compliance, then the regulator has potentially this option to send out email reminders to issuers to get them to comply. Platforms and other potential preparatory groups, right? Like raise papers or maybe marketers that are working in this space, sending a reminder, especially emphasizing regulatory risk, might drive folks to pick up your service to help prepare something, or might have them, they might just go and do it on their own, but it certainly will get an increase in our annual reporting compliance. And I think this is just from Greg Burke's opinion. I think getting up that reporting compliance is important. I think it legitimizes this space. I think it
Yes.
provides investors with information. I think it develops good habits for founders to be preparing annual financial reports, to see what that information looks like and to take the perspective of what an external person sees in your firm, right? If you want to raise capital, it's important for you to think about what your firm looks like to everybody else. And how do you do that? You prepare something for them to look at that's financial and as objective as possible, following US GAAP and following, the requirements laid out by the regulations. So I think, yeah, our big takeaways are compliance is low, email reminders emphasizing regulatory risk are effective in increasing compliance. And in a market where enforcement is low and we can test a bunch of different reasons why a manager would want to comply with a reporting mandate, the thing that clearly dominates is regulatory risk.
Regulatory risk is driving. Email does get more people acting, and even though compliance is low, this is something we all need to be looking at. Greg, thank you for putting together this research. Thank you for putting this type of focus into the regulated investment crowdfunding space. I definitely believe it's what the industry, what the community of issuers, of investors, of everyone involved needs right now. So being able to have this aggregate data then analyzed and put into these formats, I believe is going to show a better percentage in 2026 if it's circulated correctly. And thank you for taking the time to hop on the podcast and break it all down with us here today.
Absolutely. Thank you for the invitation. I'm always happy to share a little tidbit of the stuff that I'm working on, and it's great to get folks in the space interested. And hopefully, there's something you can learn from us academics in our little classrooms and offices down the road. There's a few things that a couple of you can take away and learn from, and that's always a good thing. So happy to be here. Always happy to answer questions, and I hope people enjoy looking through the paper.
And I really echo that invitation from Greg to take a look at the paper, get to his site, get on SSRN. Greg, thanks again. Want to thank everybody for tuning in. Greg, we'll look forward to having you on when talking about your next paper leading into the filings for 2026. But I want to thank everybody for tuning in. We'll see you next time. Take care.